welcome to, I guess, we're essentially going to have a talk about Fever today, what we are, what we do, what we aim to do, what our goals are. I'll start by introducing myself. I'm one of the co-founders of Fever, and I'm joined today by Trubee, our CEO, who you can introduce yourself, Trubee.
Yeah, thanks for the intro, George. I'm Trubee. I'm excited to do this informal chat about our company. And I come from a background in math and stats, and George comes from a background in finance and investing. So we've joined forces to put together a financial product, which is a compelling fair value estimator for different parts of the US stock market. And we're excited to dive in today and tell you a little bit about why we think it's a cool new avenue for valuing different parts of the stock market.
Absolutely. So I wanted to essentially formulate a handful of questions to ask Trubee. Uh, Things that I have been asked by other people that maybe together we could shine some light on, or you can help shine some light on, and explain specifically what we are, who we are, what we do, and what we aim to do. So I'll go ahead and start by asking, what is Fever?
So FVEr is FVEr, and it stands for Fair Value Estimator. And FVEr is an investment research website intended to provide high quality, fair value analysis for different segments of the stock market, such as the S&P 500 or the Russell 2000 small caps. We attempt to try to predict what we believe to be the fair value is for a particular part of the stock market, looking at long time periods of historical data. So in this case, about 20 years of historical data. And what distinguishes FVEr from other research providers is that we use a proprietary technical indicator called FVE, or Fair Value Estimator, to value these securities. And the FVE uses thousands of weeks of historical price data combined with exponential regression, which is a fancy word for best fit techniques to detect long-term market growth trends. And over long time periods, different parts of the stock market grow incredibly consistently, it turns out.
How is FVE different from other valuation tools?
So great question. First off, we believe FVE will become a fundamental valuation tool for investors as it gains traction. Unlike almost every other valuation tool, such as price over earnings or PE, the FVE is not a ratio. It's a price-based model, meaning that corporate earnings are taken into account only indirectly through price. One advantage to this is that the FVE doesn't have to decide on between using previous earnings or forward earnings because everything is presumably built into the current price. We think FVE is a much superior valuation tool compared to PE and also much more nuanced. Also, I'll just mention across the investing research landscape, there are a few attempts at exponential regression-based modeling of stock market indices, which is what we do. All the attempts that we've found are extremely elementary in their approach, and they have significant flaws, including starting point bias, et cetera. FVEr is really the first significant player in this area of valuation research using this kind of strategy, which makes it very exciting, but also difficult to gain credibility. All of our valuation models perform extremely well looking back in time, and ultimately these results will speak for themselves into the future.
So when you say 20 years of back tested data, that the Fever model, the FVE, is based off of 20 years of stock market data, Does that mean the initial starting point is from 2004?
Yeah, so good question. So the algorithm takes in 20 years worth of weekly historical data, and it can take up to 5 or 10 years during what we call the build-up phase for the model actually to output what we would consider a significant fair value estimate that's robust enough, and we have certain criteria for that. So when you go to our website, our fair value model might start at 2011 or 2012 based on a particular index because it took, say, 6 or 7 years for the model to build up enough background data to produce a statistically robust output. So the model takes in 20 years of data, but the output might not go back 20 years depending on the particular security that's being looked at. Hopefully that explains that.
So the starting point, depending on if there's enough data, could start even before 2004.
It could. We have made a specific choice to use 20 years of data based on looking at a lot of different test cases. We've looked at 40 years of data, 35 years of data, 30 years of data, 25 years of data. The more data the more historical data you put into the model, the less dynamic the FVE will be, and it will be more static. So we tried to pick a happy medium between more than 10 years and less than 30 or 40 years so that the FVE will dynamically respond to market changes, but not be so stiff that it won't change when things change in the market. We've tried to sort of look at a mix of those two and find the optimal historical time period to look at.
So as the model moves forward, will the start date of gathered data move forward as well with the model?
Yeah, it'll click up every week. The model will click up 1 week, so you'll have like a moving window of 20 years, 20 years back. And so at every week, it's 20 weeks looking backwards. So by the time we get to 2030, it'll only be taking data from 2010.
What is the mission of FVEr and what does FVEr aim to provide users?
Yeah, so that's another great question. The inspiration for FVEr was a combination of my experience in statistics and finding good opportunities for applying regression techniques to the real world. And it turns out stock market indices are excellent places to apply regression techniques to. And it was also a function of my experience working briefly at a brokerage firm where I felt like many of the investment decisions on my team were not data driven. They were driven through intuition and feel. And so I was really motivated to try to create a financial product that allowed people to make really data-driven, probabilistic predictions about the market so that their decisions were really rooted in data rather than rooted in intuition or emotions or what another person was saying about the market. Like I want to make my investment decisions based on data, not what my friend tells me about something. And so, ultimately the holy grail for an investor is to know what's going to happen in the stock market into the future. That's the holy grail. That's impossible to answer, but FVEr tries to give you probabilistic predictions about where we think a particular segment of the market might trend over the next 12 to 18-month time horizon. So for instance, the small caps, Russell 2000s, were significantly undervalued for a number of months last year. And we were really seeing an opportunity there. And, over the last year, they've done quite well and finally rallied into this year. And they probably have more room to run to the upside. And, we're not really designed for day traders. Our algorithm is not going to predict what's going to happen next week or next month. You really have to give it a 12 to 18th month time horizon to get the upside. So you can think of it more as like a long-term technical indicator for investing.
How do you see users using FVEr?
Yeah, so we have two components to FVEr. We've launched what's called our research web app, our web application, which you can see by going to our website. This web app is always going to be free to anyone. Ultimately, we want to cater towards retail investors who are tired of being blocked out of quality investment research by expensive paywalls. This is extremely frustrating for Gen Zers or millennials, which don't want to pay $500 a month for access to proprietary research. So that's one of our motivations, is to create high quality research at an affordable price for retail investors, catered towards the younger audience. The other aspect of FVEr is going to be a trading application, which is in the process of being made. This will be a subscription-based service, but it will be relatively affordable, and it will be implementing how you can particularly use the FVE to actually get out performance against different benchmarks in the index. Just the FVE web application, the free service, ultimately it provides sort of a state of the stock market landscape at any given time, showing which parts of the market are on sale and which parts of the market are expensive according to our algorithm. So if you're making a decision on May 1st and you want to figure out how am I going to allocate, this month, you can look at our web app and you can decide, hey, I'm going to put a little bit more into small caps and less into large caps because I'm seeing an opportunity there, or I'm going to put some into utilities and less into financials because utilities are a bit undervalued right now. So it should help to optimize your dollar cost averaging strategy.
The app, the model, FVEr, the FVE, it seems fairly high if I'm outside looking in. Do you see this helping primarily retail or institutional investors?
So we hope it can help everyone. There are some technical aspects to what we're doing. Computationally, our algorithm takes a huge amount of computing power to create the fair value and to test it back in time. So this never would have been possible 50 years ago. But fortunately, we can crank out the algorithm and it works quite well. So behind the scenes, there's a lot going on to get the number that you see. It's a bit technical. There's aspects of filtering and looking at many different time intervals and so forth, and trying to optimize the fair value output. However, the interface with the user, there should be parts of the interface. If you're not technically savvy and you're intimidated by math, there still should be parts of the interface on the app that you can look at. Namely, for instance, we have a star system for every single security that we cover, where if you see a 1 star, that's going to mean that the security is very overvalued. And if you see a 5 star, that's going to mean that the security is really undervalued. In other words, if you see a 5 star, our algorithm is saying that that's a good potential buying opportunity. And if you see a 1 star, that's less of a good buying opportunity. It's more overvalued. And then you can look at the overvalued or undervalued number. And if you see a positive percent, like 11%, that's going to mean that the particular security is 11% overvalued what we think it should be. And if you see like a negative 8%, that's going to mean that the security or symbol is trading about 8% under what we think it can be. And some of the graphs, especially the first graph that you see, you can track through colors, red if it's really overvalued and green if it's really undervalued, going back in time to look at various trends back in history. So it's targeted towards everyone. Someone that has more technical math background might be able to get a little more out of it, but we hope that everyone can use it. And also there is a helpful demo video that you, George, put together, which goes over a few ways to interpret the application rating.
Can you talk a little bit more about the valuation rating on the FVEr application?
Yeah, so the valuation rating is really important, actually. It's you don't want to just look at the percent over undervalue to make your decision about the extent to which a security is over or undervalued. You really want to look at the valuation rating, because the valuation rating creates an apples to apples comparison across different symbols that you might be looking at, because it normalizes with respect to standard deviation. So if you're, you know, 10% overvalued and your standard deviation is 10%, that's going to be different than if you're 10% overvalued and your standard deviation is only 5%. So in the latter case, there's a lot less volatility. And if you're 10% overvalued and the average volatility is only 5%, then in the latter case, that's going to be more relatively overvalued than in the first case if there's more swings, if the volatility is 10%. So the valuation rating takes into account the residual, or that percent over undervalued, and it takes into account the historical volatility of that particular symbol to give you a more precise way to compare valuation across the different market segments that we cover.
To more concisely put it, although we don't track Bitcoin, if we did and Bitcoin was currently undervalued by 10%, that's way different if SPY or the S&P was undervalued by 10%, because Bitcoin is such a highly volatile asset. Essentially, that's why the valuation rating is important.
That's exactly right. Yeah, you not only need to look at that percent over undervalued, but you need to look at that relative to its historical volatility with respect to the FVE. And Bitcoin would have a much higher volatility than the S&P. Just for instance, the S&P 500 has a standard deviation for our model of around 7.5% off the long-term average of near zero. So the minute that you're getting outside of plus or minus 7.5% on the S&P 500 is when you're getting outside the critical -1 to 1 standard deviation, and the distribution of the residuals or these percent over under values is reasonably bell-shaped. So most of the action happens in the center, and the FVE is most compelling as a decision maker for allocation when you're sort of on more of the fringes, because when you're in the middle, you don't really know what's going to happen. But if you're out on one of the tails, there's more convincing evidence that you're going to move to the middle, either sell off or rally.
You could almost say, theoretically, when we're on the outer edges of the model, that's where you could see more opportunity to make a larger play in certain assets.
Yeah, absolutely. That's if you want to make a data-driven statistical decision in investing using our model, it's allocating more capital to a particular part of the market when you're seeing, a 5-star rating, and less when you're seeing a 1-star rating, and potentially selling a little bit when you're in the 1-star rating, depending on your particular strategies for investing. But again, our models are inherently uncertain, and you never know what's going to happen, but you want to make a decision that is data-driven and informed. So we try to provide the best possible prediction over a 12 to 18 month horizon. We don't know what's going to happen in the next month. It took small caps almost a year before they really started rallying into the end of 2023, and we were waiting and waiting and waiting, and then they're coming around now. So it took a while in that case.
Can you explain the FVE residuals? What does that indicate?
Yeah, the residual, first off, is a technical term, so don't get turned off from that. all that really means is every week we're going to look at where, let's say, where the S&P 500 is and where we think it should be based on our fair value. And if the residual is showing 8%, that means that the actual S&P 500 is 8% more expensive than we think it should be based on our model. And if we saw a number that was minus 6%, then the S&P would be minus 6%, or it would be 6% cheaper than what we think the S&P should be trading at. So it's really your weekly percent over undervalued relative to our FVE outputs. And then we look at all those residuals over 20 years or however long the model runs after the buildup phase. We bucket them into different buckets and we plot a histogram, and we get a relatively bell-shaped distribution. Nitpicky statisticians would say that one of the flaws in our model is something called autocorrelation, and there's something to be said for that. However, there's a reason why we've purposely built the model in this way, because we are specifically trying to create some breathing room from the index, some space from the index to create better buying opportunities. And if you take larger time windows, you're going to get less correlation between consecutive weeks for the residuals.
Essentially, the residual histogram is the number of times, or, that the FVEr model and whatever equity you're looking at are lining up with each other, correct?
Close. So essentially what you do is every week you're going to get a spread between the actual equity price and the FVE equity price in a percent. It's either going to be positive or negative, or if it's zero, it means they're right on top of each other and the equity is exactly fairly priced according to our model. So every week you're going to get a, plus 8%, plus 7.9%, minus 5%, minus 4%. And you take all of those, what we call residuals, and we start plopping them in different buckets. So that maybe there's a 5 to 10% overvalued range, and we dump all of the 5 to 10% overvalued range into that bucket. And there's a minus 3 to 6% bucket, and we dump all the minus 3 to minus 6% into that bucket. And then we count up how much are in each bucket. And as you get closer to zero, which means closer to the index being exactly on top of the fair value, the more there are, the more occurrences, the more weeks there are in that closer to zero range. And as you get further out to the size, the less occurrences there are. Basically, what this is saying is that when you're in a situation where the equity is really far away from zero, you're in what's called a tail event. It's going to eventually, that differential is going to start shrinking, coming back in line. And in finance, they often call this mean reversion. So people might have heard of that term. It's going to mean revert back to the FVE. So it's going to come back to the center. So buying and selling opportunities are most compelling out at the tails.
I do find it interesting, specifically, and not every single one does this, but when looking at the SPY residual, it is almost a perfect bell curve in a way, but towards the 15% overvalued in this case, we see it tick up. So the SPY does have a tendency to be overvalued per this model.
Yeah, so there's some technical aspects to this regarding autocorrelation, which make the model that we're running not exactly in line with traditional statistical strategies, which is where you try to create a best fit, which most precisely tracks the dots. We're trying to create space between the index and the FVE to create more extensive buying and selling opportunities. So there's going to be a little more correlation between consecutive data points, which could be one reason why some of the distributions that you're seeing are not perfectly bell-shaped. And the anomaly that you're pointing out indicates that there was a situation where SPY was overvalued a little bit more in that bucket than we would necessarily have expected. But again, these kinds of things are real world, and it's never going to line up exactly perfectly to what we think.
What would have been some of your predictions in the last year or a couple of years, and have any of those predictions panned out?
Yeah, so the proof is really in the pudding. We've been making predictions live on Twitter for about a year now. Early 2022, we were seeing a big opportunity in growth, specifically QQQ and tech. It was extremely undervalued per our algorithm, and it's had a massive rally back in the last year. So we got that one right. We would argue that AI has been a big generator of that rally, but also it was significantly undervalued. So that the being undervalued was itself a huge catalyst for the rally. So we correctly predicted a comeback in growth and tech. We've been calling for a significant rally in mid caps over the last year, as well as small caps. Our 1-year price target a year ago for the mid caps was right in line with where it was last month. So basically, almost to the dot, we were on the money for the mid caps. Small caps were delayed a bit. They took slightly longer to rally through, but they've come back significantly. End of 2021, our S&P was over 15, maybe 15 to 20% overvalued at the end of 2021. We would have expected a pretty imminent sell-off based on that level of being overvalued. Boom, it sold right off into 2022, just as we thought. So we were thinking, it was quite of a risky market, came right back down into fair value. And we've run some what we call sort of forward cross models to see how likely the index comes back to the model. And over a year time span, they're generally in the 70 to 80% probability. So with a 70 to 80% chance, you're going to come back to cross through the model within a year. So all of our predictions have really done quite well in the last year.
So that's interesting. So during the course of a year, there is a 70 to 80% chance that whatever are currently tracked indexes or equities are, that equity will return to our FVE 70 to 80% of the time.
Yeah, somewhere in that range. You never know exactly. Small caps lagged a lot and are finally coming back into fair value. So they took a little bit longer than we would have expected. But say over a 12 to 18 month time horizon, I would venture to guess it's north of 75 to 80% chance that you're going to get back to the FVE. So if there's a huge differential and it's way overvalued compared to the FVE, over the next time horizon, it's going to come back into line. So that's going to suggest that the market is either going to go sideways or come back down.
Can you explain the spread?
Yeah, so the spread models are one of the coolest features for our website because they allow you to detect or compare valuations across different market segments. So for instance, growth equities versus value equities. You're always hearing the pundits say, we think growth is a better opportunity, or we think value is a better opportunity right now. Or another thing you could consider is small caps versus large caps, or small caps versus mid caps. What's the better play right now? These are questions that you hear equity analysts constantly talking about, or advisors constantly debating where they should put their money. So I pulled up our spread model tab on our web app, and I can just quickly talk you through it. This is the large cap, small cap spread model. So this looks at comparing relative valuation between the large caps and the small caps. Which one is more expensive relative to one another? Right now, the large cap, small cap spread is about 12. And just from looking at these numbers, the average spread is around 0 and the standard deviation is around 6. So right now the spread is almost 2 standard deviations away from the long-term average spread, which means something is weird. I haven't really explained what those numbers mean, but just looking at those numbers, you can see something is weird. And if you look at the last 10 years, you can see, okay, we're pretty high right now. Normally we should be around 0. We're pretty high. And the way we calculate this is the higher you are on the positive side, the more that large caps are expensive relative to small caps. And this rating helps you figure out what that level is. So right now it's LL. And if you go down to our rating system, it says large caps are extremely expensive relative to small caps. This would indicate that over time, these dots should come down to 0, which means either small caps will, be running faster than large caps, and all both going up, or large caps are going to come down and small caps are going to stay steady. So any way you slice it, small caps are probably going to outperform large caps over the next 12 to 18 months based on what we're seeing here. Does that make sense, George?
Yes, that makes sense.
So let me just quickly toggle over to our growth value. Same idea here. The further, more positive you go up, the more growth is expensive relative to value. And the further you go down, the more value is expensive relative to growth. So just look at recent memory. During post-COVID mega tech rally, the spread was 29, almost 29, and the standard deviation's 8. So you were like nearing 4 standard deviations off the long-term average. Crazy overvalued for growth, which would have suggested a significant sell-off coming in growth equities. That's exactly what happened. Over the next, it took a while for that to shake out. You never know exactly when it's going to start, but from August 2020 to January of 2023, it was a pretty much of a downward trend for growth relative to value. And then you got to January 2023, value is really expensive relative to growth, and it's rallied significantly back. As we've seen, growth has really rallied back. So this graph sort of encapsulates what actually has happened and how you can use the spread model to make informed decisions about changing your allocation outlook.
Okay. I think that explained it very well. I'm gonna say, okay, if you are focused on growth only, if all you care about is percent return, does it make sense, or when does it make sense to reallocate?
So if you're a growth investor, you're probably a younger investor with a longer time horizon, first off, or at least that's what we would expect if someone came to us saying that they're a growth investor, is they have a longer time horizon because there's they're going to expect more volatility, but more upside. So is there a reason for a young investor or a growth-oriented investor to have value exposure or to introduce value exposure into their portfolio? I would say absolutely yes. And the way I would make that decision is using the spread model. When, if you're a growth-oriented investor, I would hold growth most of the time, like, except if you are maybe 2 standard deviations above. Like at this point, I might say, okay, growth is really expensive relative to value. I'm going to take some chips off the value or the growth table and put them into value to do a hedge against that overvalued situation in growth. And that will buffer my losses when growth has a big sell-off. So I think adding value or selling growth when the spread model gets to an extreme, 2, 3 standard deviations off the norm, would be when a growth investor could take advantage of having value exposure.
Perfect. You talked about, the pundits comparing different sectors like growth and value. Would you ever consider doing a defensive versus growth model for one of these spread models?
Yeah, I think growth value encapsulates defensive versus growth, but you could make it more defensive by doing a sector-based spread model, which we haven't introduced really at this point, but it's a great idea, considering something like healthcare and consumer defensive and having that spread against like technology and communication services or something, and look at that spread, and then you could really see what that situation, looks like.
Perfect. All right, I'm gonna move on to 7. If you want to
Yep.
move to that page, you can move to that
Yeah.
page if you want. I mean,
Oh yeah.
it'll
Yeah.
make it maybe a slightly easier for me to edit. All right. What are your thoughts on the sector-based assets as they appear on the ETF summary page?
Sure. So we cover or we apply our FVE to all the S&P 500 sectors, with the exception of communication services currently, because we don't have enough data to provide an output, a long enough output to make it really significant. So other than that, we have sector coverage, and you can find that under the ETF summaries tab. And I think the sector-based models provide a window into the state of the business cycle primarily. So right now, cyclical sectors, materials, tech, financials, industrials, they're all overvalued. They're all in the 3 or 2-star range. Utilities, healthcare, consumer staples, all in the 4 and 5-star range. Consumer discretionary is a bit of an outlier. It's cyclical, so we would expect it to be more over here, but there could be reasons regarding inflation why that's where it is in this rating system. So right now, the cyclical sectors in general are overvalued, which usually occurs when the economy is firing on all cylinders and near a relative peak. So we think it's likely the stock market should top out later this year and then go sideways or down into 2025. And getting ahead of this transition and adding to more defensive sectors such as consumer staples probably would make sense if you were following our model. Adding more to tech right now, you're chasing it overvalued, and it's more of a momentum play, and it might be right for a certain amount of time. But
based on our models, is there a specific area that you would invest personally?
yeah, so at FVEr, we believe in dollar cost averaging into the market over the long term, which means putting a certain amount of money from your paycheck into the stock market every month, no matter what's happening. And what the FVEr app can help you decide is where you want to allocate that $1,000 that you're going to invest each month, you know. And all the research that we've done and back testing that we've done has indicated that the way you allocate and what you choose to allocate towards at a particular time has a significant long-term impact on your net worth down the road. So, like for instance, for me personally, early 2023, I added more growth equities to my portfolio because they were getting hammered on our model. I also added over the course of last year more exposure to small and mid caps. All of them have done really well over the last year. And, part of that is because everything has gone up, but, growth has done significantly better than value, and we would have predicted that. So I allocated more into growth. And like small and mid caps too, their mid caps have had an incredible rally since late October, up 25 to 30%. And so, it's worked for me personally, but again, I'm not a day trader, and I have a 12 to 18 month time horizon to see my upside. So if you're expecting the turnaround to happen tomorrow when you allocate into a particular sector, it might not happen immediately, but it can help you make informed decisions if you have a longer term outlook. For instance, saving for retirement, where it's going to be in the market for 20 years.
In building this application, what do you think the most interesting finding is?
So to me, by far, the most interesting finding in doing this project and building FVEr is how incredibly reliable the US-based stock market is going back decades. And, we're only focusing on the last 20 years. But if you go back really to 1940 and forward is when the modern investing era began. And you look at logged prices, so taking the logarithm of the price of the S&P 500, it's incredibly correlated to a linear regression, which means that the rate that the market is going up is very consistent. And that's true also over the last 20 years as well. If you look at S&P 500, I can just toggle along with my mouse what I sort of think fair value should be, going through the blips, and it goes up like an exponential growth function over time. And so that was the inspiration for developing FVEr. There's a lot more bells and whistles that go into making it actually a good model, but that was the idea. And the other thing is the near-term news cycle has little to no effect really on the long-term trajectory of a particular part of the market if you zoom out far enough. So as a young investor, say, investing for the next 40 years, if you hear a story about, oh my gosh, there's a recession next year, or oh my gosh, Amazon went down 6% today, or, oh my gosh, there's going to be a chip shortage, or used cars are overvalued, or so forth, you can pretty much ignore it and forget about that and realize that over the long time period, you're going to get a really reliable growth trajectory. And certainly there's black swan events like COVID or the financial crisis, which throw a monkey wrench into that trajectory. But even so, if you look at this graph, they come back over time. And when you're in a crisis, it's certainly harder to invest than when you're not, and it takes a lot of guts and courage. But this app gives me that kind of confidence to continue to stay the course. And you'll definitely be rewarded over the long term.
What differentiates a model like the FVE compared to the moving average? The simple moving average of, a stock.
Yeah. So you can turn on moving averages on our app. So we can turn on a couple moving averages and see how the moving averages compare. The short term, this is the 7-week or the 50-day and the 100-day moving average. Moving averages generally track the shape of the trajectory of the index with a slight lag depending on what the moving average interval is. So they're much close. The short-term moving averages are much closer to the index price than the FVE, which is this yellow line. The yellow line is the FVE is intended to give more space between the index and the fair value to create more extensive buying and selling opportunities, which are more compelling over longer time horizons. And if you compare this to, say, like a 2-year moving average, the longer term moving averages significantly undershoot. You can see that's this dotted line is just really undershooting the market the whole time. It has the same sort of more mellow trajectory or shape as the FVE. So the FVE in some ways can sort of be thought of as a more longer term moving average, but shifted up to split through the data more accurately. Okay, so George develops a lot of ideas related to our investing strategies, and he's very involved in developing the trading app strategy that we're going to be releasing soon, and has quite a bit of experience in options trading and using other strategies such as leverage ETFs to get out performance. So I just wanted to get a quick word from him on what are leveraged ETFs, because people probably haven't even heard of something called a leveraged ETF, and maybe a teaser about how we're going to use them in our investing strategy.
Yeah, perfect. So leveraged ETFs are products. They're ETFs that essentially aim to track the daily performance of whatever the underlying ETF or um, index is. So a 2x S&P leveraged ETF is going to, or attempts to, double the daily performance of the S&P. I think when people think of leveraged ETFs, or when they first hear about leveraged ETFs, they think that, okay, I'm going to put some money into this leveraged ETF and I'm going to double the performance of the underlying over the long term. That's not what happens. Let's say, using a round number, the S&P returns 8% per year. On paper, when people hear it, they think that a leveraged ETF is going to return 16% per year. This is not the case because it's based on the daily. And compounding works in reverse as well. It doesn't work on the upside. It also compounds downwards. So, for example, if a position loses 10%, you have to make back 11% to get back to the original value. So that is kind of a little bit of a brief overview of what a leveraged ETF is, what a leveraged ETF actually does. When we were,
And I think maybe you can touch on this, but I think people are scared when they hear leverage ETF, and they view them as sort of no-go or don't ever invest in them, and they're really dangerous and highly risky. And to some extent, they're right. Leverage ETFs bring with them a lot more risk. But maybe you could talk about how we're trying to develop ways to use them in safer ways and use them at optimal times. So like the idea is it's probably not a good idea to be in a leveraged 2x ETF for ever, because you might be in at the wrong time when there is a black swan financial crisis. But there might be times when it makes sense to add exposure to it. Am I capturing the idea correctly?
yeah, I think you perfectly capture the idea there. So originally, when we were developing kind of the very first strategy based on the FVE in its absolute infancy, we were trying to create buying and selling opportunity. We quickly found that it is always better to have market exposure. It's really not great to have a cash position for an extended period of time. It just doesn't make sense. I think a lot of retail investors make a mistake of, you know, doing this, trying to time the market and do this or that. However, where there are opportunities is using leverage to maybe capture a little bit more upside when the market has fallen significantly. One of the risks with holding a leveraged ETF um, long term is that, say we're at the top of the market and you buy a leveraged ETF and the market drops 50%, that leveraged ETF is going to be worth relatively nothing. It's going to be worth, a fraction of what it was before. It's not going to go to zero because it's based on the daily number. So it won't go to zero, but it's going to be down 90%, to dollars, to pennies even. However, if you could theoretically identify an opportunity where the market has fallen a significant amount already relative to, say, something like a fair value estimate of where the market should be, there's an opportunity to incorporate leverage when the market is already hammered, um, and maybe have more alpha on your portfolio. In so doing so, decreasing your risk if you were to just invest straight into a 2x leveraged ETFs. And maybe this is a little bit of a teaser, in some cases outperforming, you know, not only the market in and of itself, but even the 2x leveraged ETFs over the long term.
Yeah, that's great. Just to follow up on that, the strategies we're testing seem really promising, back tested, and are likely outperforming these 2 and 3x leveraged ETFs with significantly reducing the time exposure to those ETFs while also putting in these protections and circuit breakers to get out of these leveraged ETFs during periods of high volatility and extreme sell-offs. And one of the things that's interesting is you can use the FVE to try to understand when the market, you said, George, is hammered. Well, what does being hammered even mean if you don't have a relative fair value to analyze? If the market's overvalued by 40% and it drops 10% or 15%, people would say the market's hammered, and we would say, no, it's still overvalued. And so to have some sort of neutral level to make a data-driven decision about where the market should be, pair that with a leverage ETF, that's the key combo that can give you long-term alpha and also significantly reduce your beta compared to being in a leverage ETF for a long period of time.
Exactly. I mean, that's a teaser of the strategies that we are planning to present soon. We're not going to give a specific time frame, but hopefully pretty soon here, within a couple of months. I'll briefly touch on, I don't I don't like to I wouldn't tell everybody to do this. I wouldn't tell anybody to do this. But me personally, my investment profile is high risk. I like options. I'm not like a a Wall Street's bets option trader either. Not at all. Like I'm not playing earnings. I'm not buying options on GameStop or AMC or any of these meme stocks that exist in the market. I normally buy an option that's called a leap. It's called a leap or a leaps. It's a long-term equity anticipation security. Long name. It just means it's an option that's dated to expire in a year or more. I've done back testing on leaps themselves. A non-biased back test of just buying a leap on the S&P 500. I've done it on a couple different um, sectors. I've done it on the XLK and I've done it on the QQQ. And a little bit of a, I'm still in the infancy of testing this. But in my testing, I found that 7 out of 10 times when you buy a leap on a 2 to 3 year period, you win. You make money off of it and you win pretty big, and it offsets the other times that you lose your whole pot. As we have been working on the FVE model, I ran a very rudimentary back test identifying a few points in time in which the FVE indicated the S&P was highly undervalued compared to our FVE trend line, our FVE value line. During that period, I bought 12 different options during the testing period. 12 out of 12 times, those options expired way in the money, meaning every time the bet paid off and you made a pretty large amount of money doing that. Now, like I said, I'm in the infancy of testing this. I wouldn't recommend anybody try to replicate that. If, as I do more testing on it, it will be something that we will release either in our strategy section or maybe release a blog post on it somewhere. Something Trubee said earlier that kind of backs up this infant strategy is that 70 to 80% of time, 70 to 80% of the time, our model indicates maybe it's a standard deviation off or 2 standard deviations off from our,
FVE.
FVE. It returned to that FVE in a year, 70 to 80% of the time. Leaps contracts for the S&P can be up to 3 years. For most other larger positions or larger ETFs, 2 years. And then in very rare cases, leaps will only be a year. But nothing we track has a leap that's less than a year because it's just not where we don't want to provide an FVE model on a small cap uh not a small cap company, but on a
Small
small
time
fry
interval.
company or just like some random company. Like we don't want to provide an FVE model on GameStop or AMC or something. It's not in our interest. We believe in dollar cost averaging into indexes. We may release or we do have actually I do sorry, I don't even we have Microsoft Live right now, right?
No, we don't.
We don't have Microsoft Live. Okay.
We're not currently covering individual stocks
Okay.
publicly because they're more volatile. We might consider doing that in the future, but they come with more risk and less accuracy. So the more granular you go, the less accurate our model works. But just piggybacking off what George said, the leap option aspect to investing pairs well with the FVE strategy because we're more of a long-term fair value estimator. And so using long-term options in conjunction with the FVE seems to have quite a bit of potential that we're interested in continuing to explore and actually formalize a strategy that will release in addition to the leveraged ETF strategy. The leveraged ETF strategy is a bit easier to implement from a retail investor standpoint because you don't have to do an option. And so there's pros and cons to both. But I think something can be said for using, if you're a young investor, using leverage at opportune times to increase your outperformance since you have such a long time horizon as an investor remaining in your life. So that's really helpful, George, to get some insight from you.
Yeah, I wouldn't I'm not, like I said, I'm not going to make a specific statement about anything. And if you are going to try to, for anything that we have on our website, or our valuation ratings, or, our overvalued, undervalued percentage, our spread models, you can see on our website areas, if you look at our chart, where the equity was undervalued or overvalued per our FVE model. You are capable of doing your own back test if you wanted to. We are very proud of the product we've put out there. We believe in it, but clearly, do your own back testing if you are planning on developing a strategy based off our data.
Yeah, and also we'll be releasing a strategy that you can copy. If you don't want to do the back testing, you can copy what we do. We're never going to tell you that you should do this or that. We are going to run our own strategy using our model because we believe in it. And if it resonates with you as an investor, you can integrate some or all of our strategies that we're personally using in our account to fit your role, your suitability. So not everything is suited for everyone, but hopefully everyone can get something out of our website, and a lot more to be released in the near future.
Perfect. I think that wraps it up. Thank you, Trubee. And, I hope this was helpful for anyone who's interested in what FVEr is, who we are, and what we aim to do. So thank you for watching.
Yeah, thanks, George, for being a great host. And this was our fun first episode for the FVEr podcast. And we look forward to seeing you back here soon.
All right. Thank you.